Maximize Business Value podcast. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition their business on their terms. Our mission was born from the lessons we've learned from over 100 business transactions, which fuels our desire to share our experiences and wisdom so you can succeed. Now here's your host, CEO of Mastery Partners, Tom Bronson.
Hi, this is Tom Bronson, and welcome to Maximize Business Value, a podcast for business owners who are passionate about building long-term sustainable value in their business. In this episode, I'd like to welcome our guest, Anneka Sciola. She's the Director of Advisory Services at Calvetti Ferguson, one of the largest accounting and advisory firms based here in Texas. I was introduced to Anneka by my other friends at Calvetti Ferguson. She's responsible for the firm's quality of earnings reports that they create for their clients. Now, quality of earnings, or QOV reports, are becoming increasingly used in many business transactions, especially if the buyer is a strategic or a financial buyer. Many business owners don't really understand what a QOV report is. So today, we're going to go right to the source and give you a clearer understanding of what it is and how you can use it to your advantage. So welcome to Maximize Business Value, Anneka.
Thank you, Tom. So glad to be here with you.
Tell us a little bit about Calvetti Ferguson.
Sure. We are a middle market CPA firm. We are the second largest independent firm in the state of Texas, covering audit, tax, accounting, technology, risk, and advisory services. So what I do is I run the quality of earnings and valuation practice at Calvetti Ferguson. We are based in Houston, Dallas, Fort Worth, and San Antonio. And we serve clients all over the country and all over the major metro markets in the great state of Texas.
Awesome. Those are some good locations, kind of the triangle there. So what is your background and how is it that you became specialized in this line of work?
You know, Tom, that's a great question. When I was growing up, I really enjoyed making decisions with numbers, and I was looking for a career where I could do that, yet add value to whoever was going to employ me. So I know they're listening to this. So I first have to give a lot of thanks to my parents who encouraged me to dream big. My favorite class in high school was accounting. And when I got to college, I remember I asked my advisor whether he'd recommend me to take accounting or finance. And he said, you know, if you're my daughter, I tell you to take accounting because you can always do more finance with an accounting background, but it's hard to do accounting with a finance background. Well, that was pretty great advice for me. And that's what I did because I ended up taking a lot of finance classes along the way anyway. As I was going through college and grad school courses in business, one thing I kept thinking of was how can I gain the experience to give folks advice and help them save money, make money, or manage risk. So then after I graduated, that was during the Great Recession, I started at one of the big four accounting and consulting firms, advising one of the big oil majors and getting a chance to work with folks from all across the world. You know, one of the things I learned is when you're on a conference call with folks in Europe, the UK, Asia, and you're the only one from the United States, Tom, you get the short end of the stick and get stuck with a 4 a.m. call. That was...
I've had those calls before.
That's right. Yeah, I digress, but it was one of those things. So after that, I spending time at one of the big oil majors. I got to work at one of the largest power utility companies in the country, but it was consulting in a way I never thought I'd get involved in. So what I worked on there was on a company in bankruptcy. And during that experience, I learned about what companies shouldn't do to get themselves into that situation. So during my stint at that big four firm, I also got to work on quality of earnings reports, also known as financial due diligence. So after several years of working with major companies, I wanted to try something different. And that was to get into the middle market space, which is I think a lot of the business owners that you talk to, where I could really roll up my sleeves to work with business owners and their controllers and CFOs. So at that time, I came over to Calvetti Ferguson in downtown Houston, which then 8 years ago, we were maybe a fifth of the size of what it is now. I started off taking a role to audit the financial statements of companies rather than doing consulting. And then a couple years down the road, in comes one of my former colleagues from a previous firm who just joined us at Calvetti Ferguson. And he asked me if I would have an interest starting an advisory practice with him. And I said, sure, why not? So here we are, fast forward 6 years later, we built a practice where we are a one-stop shop for almost all things I think a middle market business owner would want to come to a CPA firm for. So what we can do is we can help you sell your company, value your company, perform a QOV, which is a subject of what we're going to talk about today, as well as provide you with general services to help you grow your business to the next level. And on top of that, we also do financial expert witness work, but that is a discussion for a later time. So just to wrap this up, I would say overall, I have been consulting in the merger and acquisition space for over a decade. I've represented clients on deals to the finish line and have also worked in a separate practice area of litigation support with attorneys on deals that haven't gone well. So I guess I've seen just about it all.
I'll bet you have. Now, that was some great advice from your teacher. In fact, I think back when I was in high school and I did really well on the math SAT, not so well on the English. And my piano teacher of all things, who was really more of a mentor to me, he said, Bronson, you should major in accounting. And I said, well, why is that? His name was Ziggy Hurwitz, long since passed away. But Ziggy said, look, in good economic times and bad economic times, you still got to count the money.
Got to count the beans.
Got to count the beans. So, I mean, and I looked at him and I said, does anybody really want to major in accounting? So now I've met someone. I even know CPAs that didn't want to major in accounting, right? But that's awesome. What a great backstory, and I know you've got great experience. So let's dive into the deep end. What is a quality of earnings report, and why should a business owner want to know about it?
Sure, Tom. So I would say a QOV, first of all, yes, stands for quality of earnings. So basically think of it as you wouldn't want to go out there and buy a car or a home without inspecting it first. A quality of earnings report helps a buyer, and in many cases a seller, so the folks that we're talking potential business owners we're talking to today, helps those buyers and sellers decipher some of the major financial components of a deal. So to me, the most important components are not just three items. I'll boil it down to the most three important items. Number one, what we call the historical EBITDA. And that's what I'll call the income statement approach. Number two, the historical operating balance sheet. And that's what I'll call the balance sheet approach. And number three, calculating net working capital for a true-up mechanism. So I'll talk about each in a little bit more detail, if that's okay with you.
Yeah, absolutely. I want to know, in fact, you brought up a great point, the net working capital issue. It's something that a lot of sellers overlook, right? And buyers are typically very savvy about that, and they do that. So if you want to break these down and talk about each one of them, then have at it.
Great. So the first one is the adjusted EBITDA that we'll want to look at for the past few years. So we'll want to get a view of what is first earnings before interest, taxes, depreciation, and amortization for a business. Because as you know, Tom, most businesses, besides maybe software, is valued on a multiple of EBITDA. From there, we calculate what we call normalizing adjustments to EBITDA. So those are things like your seller's compensation, discretionary expenses, non-recurring expenses, as well as any other one-off events. These are all positive things for a seller to want to adjust for because they are called add backs and would increase your value. On the flip side too, though, we would also want to decrease things of this nature on the revenue or income side. So again, looking for discretionary and non-recurring income. ultimately, this is a final number we're looking for called adjusted EBITDA. What that's supposed to represent is what a buyer would expect to be their EBITDA when they take over the business. And that is why they're going to pay you a multiple based on this EBITDA number. So that's item number one. Item number two is, so the first thing we focus on is adjusted EBITDA, which is what we calculate on the income statement. Then the second item we focus on is documenting the operating assets and liabilities that would go into a transaction, which I see as typically a sale of assets on a cash-free, debt-free basis. So this will be taking the balance sheet to figure out what assets are tied to operations and what liabilities would come with operations versus those that would get paid off. So you'd be surprised in some of the assets I have encountered. In some instances, besides your typical owner, personal vehicles, I've encountered assets such as cattle and various other animals. And Tom, let's just say the nature of the business has nothing to do with husbandry. Seen it all. So going back to this exercise, which is figuring out assets and liabilities, getting this documented is also important because they will be included in the purchase agreement schedules. All right. Last thing, this balance sheet item segues well into my next, which we were just talking about earlier, which is working capital. So that's item number two. The third thing we focus on is working capital analysis. Sometimes I do see, I should say, that business owners keep their eyes so much on the purchase price that they forget that the purchase price they get in the offer is just part of the total purchase consideration. At the end of the day, the business owner gets their cash in the bank back, but it's usually subject to a net working capital true-up mechanism, which determines how much net working capital is needed to fund the business. So that ultimately, after the settlement, the seller will either get a check back for a net working capital excess, or they have to cut a check back to the buyer for a net working capital deficit, which is not what we want. The seller never wants to have to get payback to the buyer. And so I think it's always good to have what we call the normalized net working capital. Some people call this the PEG, defined and agreed upon upfront before the deal closes. And that's what this exercise of the QOV is intended to do. So there you have it. The QOV report is really there to tell the story of the business through its numbers and provide buyers and sellers illumination of the company through its finances. Of course, there are a lot of other things we would typically do as part of the QOV, but those three I mentioned are the most important that comes to mind. There are other things a QOV report can cover, and they include doing a lot more to kick the tires and telling the story of the business based on the financials. So we at Calvetti Ferguson have what I call an a la carte approach to how we can scope out a QOV, and that is completely tailored to the needs of the buyer of our services.
So do all QOVs contain at least those three components, or do some of them just have the EBITDA or the balance sheet or the net working capital? I mean, or because I really want to educate our business owners about QOV. So do they all have those components, and then there are other things you can add?
Yeah, sure. So almost always they would contain those components. The one I always see is the income statement approach to get to adjusted EBITDA. I would say that probably comes, 99% of QOVs have that. And then 95% of QOVs I do have the adjusted EBITDA and the net working capital. On the balance sheet, I would say 50-50, whether the buyer of the services want that.
Okay. All right. Well, that now, how is this? Do you also do audits, or are you just QOV?
Yes, we are a full stop shop. And so we do audits, compilations, reviews, as well as QOVs.
All right. So I had on another guest some months ago, some weeks ago, talking about audits. So this will sound to the uneducated ear very similar to what we talked about in audits. How is a QOV different from an audit?
Yeah, sure. So an audit, at the bottom number you get to is what we call US GAAP number. So in the United States, we have general generally accepted accounting principles that an audit ensures you get to that number, which is net income. And that's a great first number. I would say businesses that have audits done will tend to have a much easier QOV. So audit can be the first step into a QOV, but what the audit cannot define, because it is not a US GAAP number, is that adjusted EBITDA. So the audit is not going to illuminate for a buyer all of those add backs we talk about. It's not going to get to the net working capital adjustment or necessarily define the closing balance sheet. And so I think it would be great to have an audit on the front end of the process, but it certainly does not get you there to the finish line.
Great. That is a great distinction between the two. And I just want to caution business owners. It is so very important to understand that adjusted EBITDA number. That's one of the first things we do when we start working with our clients. And you'd be surprised. I hear you say you've had some unusual things on their balance sheet. I've talked with business owners that have run their business as a lifestyle business that when I talk to them about their discretionary spending, their personal vehicles, their cell phones, things like that, I've heard things from all of those to the pool guy at home, the lawn service, the maid service at home, all of these things. And it's so important for business owners to understand that buyers many times will get adjustment fatigue when they start seeing things like that and seeing how the business had been run that way. So my advice always is to try and clean those things up 2 or 3 years in advance. Pay the taxes on it now. It will pay back in spades later. But you also mentioned that, and this is something that is so very important. There's lots of ways to value a business out there, but for most businesses, and I'm talking about businesses, the highest number of businesses are less than 10 million in revenue. But if you're in that lower middle market group, which is kind of 100 million and less, I'd say 95 to 98% of all transactions are based on a multiple of earnings. I hear people all the time thinking that it's based on a multiple of revenue, or that they can get a multiple of recurring revenue. Those things are important, but most transactions are valued on a basis of the earnings. And so it's so very important to do that and to really understand how businesses are valued in your space. That's something that we can help business owners with. And so every chance I get, I want to try to dispel that myth that businesses transact on revenue. Certainly some do. Certainly some do based on a transaction of technology, but the vast majority trade on earnings. Would you agree with that?
Oh, I absolutely do. I think I probably can count on my hands maybe a couple of transactions I have a year that trades on multiple of revenue, and always they're just technology. They are SaaS-based companies. The rest of those that I see is trading off of EBITDA.
Yeah, that's so it's really important for me to keep drilling that at business owners. So thanks for doing that. And I took a great risk of saying that without getting your approval first. So QOV, let's get back to the QOV, those 3 components. Would you say that QOV reports pertain mostly to buyers or to sellers or to both?
Great question. I would say, Tom, both. There are both buy side and sell side QOVs. Most of the time, a buyer for sure would want to engage a professional to perform a QOV, similar to the inspection analogy I gave earlier, because they would want to get it done to inspect the business's finances and then put a value on the business based on what they're seeing as a good and solid EBITDA of the company. I will also say we also get a lot of sellers coming to us wanting to get a QOV done as well. That's because the seller wants to know what kind of value they will likely get in the market given where they're at. So they'll come to us to get a QOV done to calculate their EBITDA, as well as many times they come to us to run some modeling and researching comparable transactions to come up with a range of values for their expectation purposes. So I'll share with you a story. A couple of years ago, I had an owner come to me with this very, very unique business. They're the only people who do what they can do. And because of their specialized skill set, they're in high demand. Anyway, the owner came to me asking for a QOV to be done because he and his wife were in the process of deciding whether they wanted to sell the business or keep running it. So we did a QOV report for him, ran some modeling, and from there, he could see based on his backlog and projects how much he would be cash flowing versus if he were to cash out today. It turned out he was very happy with this cash flow projection. And based on the result of the QOV, he made a sell or hold decision. He ended up holding and is still enjoying that today. So I would say not every QOV I've done resulted in a deal of the seller. What I believe in, Tom, is empowering the business owner to do what makes most sense for them and use a QOV as a tool to make that decision. So as part of my practice, we have business owners I represent that not only ask us to perform the QOV for them, but they also ask us to represent them on the entire sell side process as well. So that's everything from putting together the QOV report to marketing the transaction to representing the owner from selection of an offer all the way to closing. So that's what I'll call our holistic sell side M&A consulting services. And Tom, I'll tell you the great thing about the business owner getting a QOV is that once you have it, the buyer now has a roadmap to quickly perform their QOV or just review the sell side QOV. I've seen many times that a buyer just tells us, hey, can you update the QOV we do for the business owner once they are under contract? So I'll give you an example. Let's say you engage with us to represent you to sell your business. We perform the sell side QOV for you. When we then talk to the potential buyers and they hear a sell side QOV report has already been done, they usually quickly take the numbers from the report to come up with an offer. Then if you sign up with their offer during the formal due diligence process, buyer would tell me, hey, Anneka, can you update the QOV report as of the latest date of the company's financials? Sure. Of course, the buyer would do additional due diligence of their own. As you can envision, this process goes by much smoother because we have a QOV report as a starting point.
It can be a painful thing if you've never gone through an audit or a QOV. And I wanted to give my own example. I have a great friend, David Hammer, who sat on the board of a business that sold, gosh, I want to say probably 2016. They knew that they were going to go sell the business, and he strongly encouraged the investor group to get a QOV. It was not inexpensive, right? I mean, they were a fairly sizable business. And David specifically said he's one of my most trusted M&A attorneys in a solo practice here. But he said that he firmly believes and can document that they increased the value of that business by $30 million by having that data in advance. And then they had clues of things that they needed to do. So I'm a big proponent of doing a sell side QOV before you start working on the transaction. And I'm just a hats off to Calvetti Ferguson, because it's very rare to find an accounting firm that has these advisory services that are also offered in the firm. So hats off to Calvetti on that. So we've talked a little bit about, kind of the use of it, what it entails, but are there some pitfalls that you've seen in QOV work?
Yeah, I'll share a couple that I typically see. And I've seen one earlier this year. We had a seller that had EBITDA adjustments based on the balance sheet. So this one seller had almost half of their EBITDA adjustments, which was about $2 million or some change in just balance sheet entries. And balance sheet entries by their nature don't impact EBITDA, and therefore they don't qualify in what I described earlier as an add back. So in that case, they didn't really know what adjusted EBITDA was. And unfortunately, their service provider didn't really explain it to them. So when we encounter that, it was a big surprise to that seller. And unfortunately, it impacted what they expected to be the EBITDA and thus the valuation. So that's one example. It's always sad to see when a business owner thinks they have this much, thinking that they're hearing things like non-recurring, personal. So they think everything that is recorded can be an add back, and it's not the case. I've also seen some sellers take very strong positions on the business expensing of personal expenses. So going back to a little bit of what you talked about earlier, Tom, I personally don't have a problem with this approach, but I have seen buyers, yes, sometimes balk or get fatigued at this, especially when they see that a significant proportion of EBITDA comes from those discretionary expense add backs that we were talking about earlier. So it's just something to think about. And I would especially advise sellers to engage a qualified QofE advisor to help them level set expectations and get a preliminary EBITDA adjustment and spend, some time just thinking through their plan of attack, whether really it makes sense for them to incur all these discretionary and book all these discretionary expenses in their income statement. I always think it's better to know now than later. And that's why getting a preliminary EBITDA assessment always seems to make sense to me. And the last pitfall I've seen quite often is the old adage, time kills all deals.
Yes. Tell us about that.
Yeah. So going back to that, as a seller, having a QOV in your pocket can not only help you understand the value of your business and give you strategies in which to negotiate with a potential buyer, it will also help you save a lot of time, confusion, and headache in the process of talking to interested buyers and or during the actual due diligence process. I mean, I've seen deals that, so explaining, why QOV kind of help mitigate that time kills all deals. Now, in my personal experience, I have dealt with deals that have dragged a year or two because the books are not clean. And I know we can certainly talk about, some of the things I would advise to sellers about how to get about having books that are clean. But that's really what I have seen, deals that can close in 45, 60 days and have that time frame in the LOI to be contemplated seems to go a lot better than deals that are open-ended or deals that just drag months and months. And then so buyer and seller both get fatigued.
I agree. I hear that frequently. Time kills deals. As I tell business owners, the faster you can go during due diligence, the more prepared meaning the more prepared you are in advance, that the more likely the deal will actually close. I think as they drag on, I've seen them go on for a year. I've never seen anything go on for 2 years, but I've seen them go on for a year. And at that point, the seller is almost or the buyer has almost forgotten why he wants to buy the place in the first place. So make sure that it goes quickly. And a way to do that would be being prepared long in advance. We tell business owners that they should be thinking about these things at least 3 to 5 years before they want to exit their business. So one last quick question before we take a break. How do you think a QOV report would add value to a business owner looking to sell?
Sure. Going back to your previous point real quick, nobody wants a 5-year engagement. So same thing between buyer and seller. As far as how a QOV could add value to business owner looking to sell, I think most of our deals that involves a business owner getting a QOV, once we see that, a lot of times once we get that done, we see we have a much shorter marketing time horizon as well as an expedited due diligence period. So it goes back to time kills all deals. I've seen marketing take a few short weeks and a due diligence period of as low as 45 days after you get the sell-side QOV.
Wow, that's amazing. That's rare. Now, I don't. This podcast is coming out in early October. I don't want business owners to think that they can start thinking about it now and sell before the tax law changes at the end of the year. So it's important to plan for these things in advance. So while yes, it's possible that could happen, the odds are stacked against you. So awesome. Hey, we're talking with Anneka Sciola, and we're going to take a quick break. We'll be back in 30 seconds.
Every business will eventually transition, some internally to employees and managers, and some externally to third-party buyers. Mastery Partners equips business owners to maximize business value so they can transition their businesses on their terms using our 4-step process. We start with a snapshot of where your business is today. Then we help you understand where you want to be and design a custom strategy to get you there. Next, we help you execute that strategy with the assistance of our amazing resource network. And ultimately, you'll be able to transition your business on your terms. What are you waiting for? More time? More revenue? If you want to maximize your business value, it takes time. Now is that time. Get started today by checking us out at www.masterypartners.com or email us at info@masterypartners.com to learn more.
We're back with Anneka Sciola, and we're talking about an exciting topic. It should be an exciting topic for business owners: quality of earnings. So let's jump back into the topic. What does a business owner need to do to have a successful QOV engagement?
Sure. Yeah, I would say, first of all, getting a crash course on what EBITDA is and what a QOV is, which is exactly what we're accomplishing today. So you're already halfway there to that goal. I think besides that, the cleaner the books, the better. I also see business owners that have good accounting methods, especially being on an accrual basis of accounting, have it easier with a QOV and a sell-side process. I'm not saying everybody go run out there and get an audit done or abandon your cash basis method of accounting, but generally speaking, having cleaner books and following US GAAP method of accounting tends to help business owners be more successful.
That's a great point. I see a lot of business owners who really manage using cash basis financials. And it's my personal opinion that to manage the business day to day, you need to be looking at accrual basis, right? And thinking about, where things really belong, as opposed to cash basis. Look, you can do your taxes on a cash basis, which I would encourage for small businesses. But you really should be managing the business on an accrual basis. Would you agree with that?
I do, especially as you're getting close to selling. I don't personally have a problem with managing the business from a checkbook perspective, but when you're looking to sell to more sophisticated buyers, a lot of times they're in, institutional investors, private equity, strategic buyers, they're going to have a hard time swallowing and incorporating the cash basis numbers into their modeling, which is on an accrual basis. And so oftentimes, what will tend to slow down the process is then we get involved and we help them, help the sellers, the business owners come up with the cash to accrual basis adjustments. And so that is something we can do. But I think it's always good to be, to your point, Tom, being more prepared.
Yes, I can't say that enough. Always be prepared. Use the Boy Scout motto, or what, I don't know how many fingers it is. The Boy Scout, always be prepared. So now, speaking of being prepared, I'll bet you've seen almost everything over your years of doing this work. Could you give us a real success story for someone who did a QOV?
Yeah. I had one that was a 74-year-old client who owned a container distribution business. And so one thing I'll bring up, we haven't talked about tax due diligence and consulting yet, but we were able to find our client, the 70-year-old business owner, $3 million in value because of our tax consulting work. So what we did was we performed the QOV for him as a business owner, marketed his business, which took about a month or two to find a really great strategic buyer, gave him tax consulting and saw him to the finish line. Somewhere in between that process, the buyer asked for a $3 million reduction in purchase price. Well, because of our work in the tax structuring, and we are a full service CPA firm that we also bring in the tax consulting side of it as well, we were able to net the seller about the same amount of cash consideration to offset the reduction in purchase price, where at the end of the day, he, the seller being, walked away on a post-tax basis with roughly the same amount of money as he originally expected, all because of the tax structuring that we were able to come up with. So he was happy, the buyer was happy, and I think he ended up taking his proceeds, retiring, started a goat farm because that was his hobby. So that's one success story I could share with you. I could share with you another if you would like to hear that as well.
Sure, bring it on.
Okay, I've got another client of a smaller business, and he got tired of, as you know, being in the South here, the Houston summer heat. He had a business where he spends his time primarily outdoors, but he would prefer to live in Montana and spend his summers there instead. So ultimately, through the QOV and sell-side marketing process, we landed him several offers. Turned out he picked a lower offer, but with a buyer he was more comfortable with, and that accomplishes more of his intangible goals rather than just the monetary goal. So I would say what makes us unique is that we don't bind our sellers to us with a timetable, nor do we try to sway them one way or the other with the options. We just like to give our clients objective advice, being that trusted advisor and sounding board, and encouraging our business owners to go after the option that they are most comfortable with and meets the most of their criteria as possible. So imagine that he went with a lower offer to be happier.
Yeah, I love that. I actually, in one of my exits, I went with a lower offer because I thought it was the right thing to do for our people, for our customers, for the long-term success of the business. And sometimes that is a smart play. But if you don't even understand your options, right, then it's hard to make those decisions. And we do the same kind of thing.
Right.
We don't care what we help business owners design and execute their ideal exit strategy, but we don't care, as we're not an investment banker, we're not a sell-side representative. All we do is the pre-work to get a business ready. So if they want to do an ESOP or a sale to a leveraged buyout for management, or sell to their children, or sell to a third party, we don't care. We're totally agnostic to that. We just want to help business owners achieve their goals. It sounds like we have great alignment with our values between Mastery Partners and Calvetti Ferguson. So, is there any other advice that you would like to give to business owners that are looking to sell?
One of the common questions we ask business owners when preparing to exit is, what would you like to do with more time, energy, and capital? We are always delighted and curious to hear the answers, because that helps us understand where the business owner is with their personal goals and visions, and then we can better understand how we can help them meet these goals. So to answer your question, I would say to the business owner, spend time thinking through these types of questions. Also, surround yourself with good advisors. I would tell every exiting business owner I encounter that what you need is a good attorney who's skilled in transactions, not something different like real estate or divorce or something. I've been with the same attorney who's drafted my will or whatnot for a decade. I would say get someone who's skilled in doing reps and reps of transactions, and a good business financial advisor, whether that be a CPA or not. Interview your advisors and make sure that they have good references and also understand your vision and where you're trying to go.
I'm really disappointed that you didn't say that they should engage with Mastery Partners, but I'll get over that really quickly, Anneka. So
and Calvetti Ferguson.
And Calvetti Ferguson, exactly. So that is some great advice for business owners. They should be thinking about what that future is, because the stats are that of the only 17% of attempted transactions reach the finish line. And that's of all businesses less than 100 million in revenue. And the smaller you are, the more challenging it gets. The number actually goes down. So 17% success rate. Out of that 17%, only 60% or a full 60% are unhappy a year later with the outcome, right? And it's because they don't spend time thinking about, what am I going to do next? You've poured your life and your soul into this business. And so you should be intentional about what's next. We call that the third act here at Mastery Partners. And so I like that when you're talking with business owners about, dream about what you're going to do. You have access to capital, you're going to, and how are you going to spend your time? I think that is such overlooked component of exit strategy. So I'm really glad that you brought that up. That is great advice. Now, we've already talked a lot about kind of how Calvetti Ferguson is differentiated from other CPAs. And by the way, you mentioned that attorneys are not all cut from the same cloth. Right. They specialize. You always need to get an attorney that specializes in these types of transactions so that they can help you. That goes for CPAs as well. Just the person who's been doing your taxes or being a bookkeeper for you, they may not be qualified to represent you in a transaction. They may be, but they may not be. And so you need to do that investigation to make sure. It's okay to have them keep doing the things that they're doing, but you might need to get some specialized help. So I think that is an important component as well for business owners. But back to Calvetti Ferguson, what sets you guys apart from other accounting and advisory firms, other than all the things we've already talked about?
Great question. We have members in the firm who have been in the company's shoes and they have served as CFOs and controllers. Our very own founders of the company, Mr. Jim Calvetti and Jason Ferguson, were that CFO and controller who are today entrepreneurs and can help guide companies because they've been in your shoes. Also, I give credit to the gentleman I mentioned earlier, who earlier in my career asked me to help him build this practice, Chin Yu, who was also a CFO who took a company public and grew it from $6 million in EBITDA to $60 million in EBITDA in 4 years.
Wow.
And he says growing companies is hard and the PTSD is real if you're not prepared for it. So give him credit for that saying. I have a great team of analysts who I know if they're listening, I want them to know that I think they're world-class and have the ability to run their own practices and book of business one day. So as a wise man once told me, Tom, I am just paving the runway, but you're the one taking off. And so that's what I would tell them too. Finally, I'd say what sets our practice apart from the other firms is that we bring a holistic service offering to business owners. In most shops, you have to go to one provider for the QOV, another for the valuation, another to get your business marketed, and another to get tax. We do all that within one umbrella with one team. So I've been there in that big firm where everyone worked in their different silos. And let me tell you, it was hard sometimes to get to know my colleague across that cube.
I totally agree. Those are great services that really set Calvetti Ferguson apart. I'm glad you mentioned Chin. I had an opportunity to have lunch with him a few months back and introduced by another great friend over at Calvetti Ferguson. I have yet to meet somebody that I don't like at Calvetti Ferguson, and that's important. So I think you'll really enjoy spending time with all of these folks. Look, one last business question. This podcast is all about maximizing business value. So, Anneka, what's the one most important thing you would recommend business owners do to build long-term value in their business?
I would say focus not only on building sustainable EBITDA, and that starts with having a great repeatable and scalable business model and all the great things Tom is teaching you, but also making sure that you're training your next generation of leadership to take over, because if a buyer sees that the value of the business is just with you, then the value of the business will be very limited to just, well, you.
I love that. I love that. That is some definite great advice. Business owner dependency is probably the great deal killer. As I say, for like, if you've got a business that's 50 million in revenue and it's got some owner dependency issues, you're going to take a haircut on the valuation. That's just pure and simple the way it is. But if you have a business that is $10 million or less that is owner dependent, it's almost worth nothing. Because where is all that knowledge? Where, it's not a transferable business. That's the thing that we harp on all the time with our clients. We are trying to build a business that is scalable and transferable over time. And you can't do that if you just retain all of that knowledge in your head. So I love that as great advice to give. We don't hear that very frequently. So thanks for asking. But I'm not going to let you off the hook, even though or thanks for answering that way. I'm not going to let you off the hook, even though you gave a great answer there. We always ask my favorite question at the end of our podcast, and our listeners stay tuned just to hear the answer to this question. So here, are you ready for this, Anneka?
Okay. Oh boy.
What personality trait has gotten you into the most trouble through the years?
Oh goodness, that is an interesting question.
Don't say math.
No, that's not personality related, right?
Right.
Well, I would say I'm a pretty direct, straight shooter. And over the years, as I was developing my skills as a manager, not only of team members, but also of my client relationships, I've learned that tailoring my message to my audience and seeking to understand them first has helped me get out of situations that would have gotten me in trouble if I came across as too candid up front. Even though I'm thinking those thoughts internally, it's, the 7 habits of effective people. My favorite one is seek to understand, then be understood.
Yes. I love that. That's one of my favorites. Steve Covey's book, 7 Habits of Highly Successful People. Seek first to understand, then to be understood. So that has been a challenge for you in years past?
I would say so. And just thinking more about, into that message.
You mentioned earlier that your parents might listen to this podcast. I'd be interested to know what their answer might be to that question.
I'll have to ask them and get back to you.
Yeah, I'd never asked that to my wife. We've been together for 30 and a half years because she'll give she won't even know which one to choose about the things that get me in the most trouble. Look, this has been so much fun. How can our viewers and listeners get in touch with you and the folks at Calvetti Ferguson?
I will say first, I don't think I'm going to ask my husband, Peter Sciola, but I will tell you, he has been my rock in being able to operate the practice this way. First and foremost, I really want to thank you for your time. It has been a pleasure getting to know you, Tom, and following your podcast with all the great information that you provide. So thank you very much for the service, the servant leadership you do for all the listeners out there today. To get in touch with me, you've got my LinkedIn profile as well as my bio page on calvettiferguson.com.
Awesome. That is perfect. And you can see all the great people at that website. Thank you, Anneka, for sharing your knowledge with our audience and our listeners today.
Thank you, Tom.
You can find Anneka Sciola at Calvetti Ferguson, CALVETTI Ferguson. Everybody knows how to spell Ferguson.com, or on LinkedIn. And of course, you can always reach out to me and I will be happy to make a warm introduction to my friend Anneka Sciola. This is the Maximize Business Value podcast, where we give practical advice to business owners on how to build that long-term sustainable value in their business. So be sure to tune in each week and follow us wherever you found this podcast. And if you'd like to get weekly updates from us, just go to our website, masterypartners.com, and you can sign up for our weekly newsletter there that is jam-packed with all kinds of great information about maximizing business value. So until next time, I'm Tom Bronson, reminding you that it just might pay to be proactive and get a quality of earnings report before you start your exit process. So think about doing that while you maximize business value.
Thank you for tuning into the Maximize Business Value podcast with Tom Bronson. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition on their terms. Learn more on how to build long-term sustainable business value and get free value-building tools by visiting our website, www.masterypartners.com. That's master with a Y, masterypartners.com. Check it out.
That was perfect. I wouldn't make any changes on that.